Ever wondered how Forex, stocks, and synthetics trading works? Well, in today's fast-paced, interconnected world, trading plays a pivotal role. It's the lifeblood of the global economy, the engine that drives growth and prosperity. But what exactly is trading? Let's break it down. Forex, or foreign exchange trading, is all about buying and selling currencies. It's like a giant marketplace where currencies are the goods. Stocks, on the other hand, are shares of a company. When you buy a stock, you're buying a piece of that company, betting on its future success. And then we have synthetics. Now, this is a bit more complex. Synthetics trading involves creating financial instruments from other assets, combining them in such a way that they mimic the behavior of another asset. Each of these types of trading has its own unique characteristics and opportunities. So, buckle up as we take a deep dive into the world of trading. First off, let's talk about Forex trading. What is it exactly? Imagine a bustling marketplace, a hub of exchange and commerce. Now, replace the usual goods with currencies, and you've got the concept of Forex trading. Standing for foreign exchange, Forex is a global marketplace where currencies are bought and sold. It's a vast, dynamic market with nearly $5 trillion traded daily. That's trillion with a T, folks. At its core, Forex trading is about the relative value of one currency against another. It's a game of comparison where traders speculate on whether one currency will rise or fall in value against another. Now, here's the catch. Currencies are traded in pairs. Picture it as a seesaw. When one side goes up, the other goes down. For instance, if you're trading the euro against the US dollar and you expect the euro to strengthen, you'd buy the euro and sell the US dollar. Conversely, if you expect the dollar to strengthen, you'd sell the euro and buy the dollar. This constant tug of war between currencies is influenced by a myriad of factors, from geopolitical events to economic indicators. That's what makes Forex trading so exciting and at times unpredictable. So why is Forex trading so important? Well, it facilitates international trade and investment by enabling currency conversion. If you're in the US and want to buy a French wine, you'd need euros to pay for it. That's where Forex comes in, creating a mechanism for you to exchange your dollars for euros. Moreover, it's a market that never sleeps. With trading centers spread across different time zones, from New York to Tokyo, you can trade Forex 24 hours a day, 5 days a week. In essence, Forex trading is like a global financial heartbeat, constantly pulsating, driving international commerce and investment. It's a world of opportunities where every tick and talk can potentially turn into profit. And there you have it, Forex trading at its simplest. But what about stocks? Now let's switch gears to stock trading. Sounds complicated, right? Well, not really. Picture this. The stock market is like a colossal supermarket, but instead of groceries, you're shopping for pieces of companies. These pieces, or stocks, represent ownership in a corporation. When you buy a share of stock, you're buying a slice of that company, making you a part owner. Let's say you've got your eyes on a tech startup that's making waves in the industry. You believe in their vision and you think they're going places, so you decide to invest. You purchase 100 shares of this company's stock. Now you own a tiny piece of this startup. If the company does well, the price of the shares you bought will likely increase. You can then sell these shares at a higher price than what you paid for them, and the difference is your profit. But remember, the stock market is a two-sided coin. If the company doesn't do well, the price of the shares could drop, and you might end up selling them for less than what you paid. That's a risk you take as a stock trader. Now you might be wondering, how do you buy and sell stocks? Well, it's simpler than you might think. You can do it through a brokerage account, which is like your gateway to the stock market. Once you've set up an account with a broker, you can start trading. You tell your broker which stocks you want to buy or sell, and they execute the trade on your behalf. Stock trading can be a great way to grow your wealth, but it's important to do your homework. Research the companies you're interested in, understand the risks, and make informed decisions. So that's stocks for you. But there's one more type of trading we need to discuss: synthetics. Finally, we arrive at synthetics trading. But what does synthetics mean in trading? Well, in the simplest terms, synthetics trading is all about mimicking the price movements of a particular asset without actually owning the asset itself. Think of it as a wolf in sheep's clothing, or better yet, a financial chameleon. Intriguing, isn't it? Synthetics trading involves the creation of what we call synthetic positions. These positions are created using a combination of financial instruments such as futures, options, and swaps. The aim is to replicate the payoff of a specific asset. For example, you could create a synthetic position that mimics the behavior of a certain stock, but instead of buying the stock outright, you're using a combination of options and futures. Now, why would anyone want to do this? Well, there are a couple of reasons. First off, synthetics trading can be used as a strategy for hedging. By creating a synthetic position that behaves opposite to your existing position, you can offset potential losses. It's like having a financial safety net. Secondly, synthetics can be used for speculation. Traders can create synthetic positions to take advantage of expected price movements. If you believe a particular stock is set to rise, for instance, you could create a synthetic position that benefits from this price increase. But let's not forget, every rose has its thorns. Synthetics trading, while offering flexibility and opportunities for profit, also carries a significant amount of risk. The complexity of creating and managing synthetic positions can be daunting, especially for beginners. And just like with any other type of trading, there's always the risk of losing your investment. So, should you dive into synthetics trading? Well, that depends on your risk tolerance, your trading skills, and your understanding of the markets. It's not for the faint of heart, but for those who master it, synthetics trading can be a powerful tool in their trading arsenal. And that, in a nutshell, is synthetics trading. So, how do all these types of trading compare? Now that we've explored Forex, stocks, and synthetics, how do they stack up against each other? Let's begin with Forex, or foreign exchange trading. This global marketplace is all about buying and selling currencies. A key advantage here is the continuous operation. The Forex market is open 24 hours a day, 5 days a week, making it accessible for traders around the globe. However, this also means you need to stay tuned to global events that could impact currency values, which can be a bit of a challenge. On the other hand, we have stock trading. This involves buying shares in specific companies with the hope that their value will increase over time. Unlike Forex, the stock market has set trading hours and is closed on weekends and holidays. This can provide a more structured trading environment. But remember, stocks can be highly volatile, and their prices can fluctuate rapidly based on a company's performance or market news. Lastly, let's talk about synthetics trading. This is a more advanced form of trading that involves creating artificial financial instruments, or synthetics, from a combination of other financial products. The major advantage here is the ability to create a wide range of investment strategies that can potentially offer higher returns. However, synthetics trading can be complex and requires a deep understanding of financial markets, making it less suitable for beginners. So what's the bottom line? Forex trading offers flexibility with round-the-clock operations, but requires a keen eye on global events. Stock trading can provide a more predictable schedule and the excitement of investing in specific companies, but with potential volatility. And synthetics trading can offer a broad range of strategies and higher potential returns, but it's more complex and best suited for seasoned traders. Every type of trading has its own risks and rewards, and it's crucial to understand these before diving in. Your choice should depend on your trading goals, risk tolerance, and level of expertise. So as you can see, each type of trading has its own unique features and considerations. Wow, we've covered a lot today. Let's quickly recap what we've learned. We started off by getting familiar with the world of trading, a dynamic and often thrilling financial arena. We then delved into Forex trading, which operates on a global scale and involves the exchange of currencies. It's a market that never sleeps, folks. Next, we ventured into the realm of stock trading, buying and selling shares of companies, and how it can be a lucrative venture when done right. We also explored the intriguing world of synthetics trading, a more complex field that opens up a world of opportunities through a combination of assets. And finally, we compared these three forms of trading, highlighting their unique characteristics and potential benefits. And that's it. We hope you've gained a better understanding of Forex, stocks, and synthetics trading. Remember, it's not about getting rich quick. It's about making informed decisions and learning along the way. Happy trading!